the macro setup ahead of Fed Chair Jay Powell's speech is pretty interesting only because this is not a major sell-off, but there does seem to be ratcheting down ever so slightly of risk with record highs in stocks.
No, you're absolutely right. I think that the jobs number on Friday, or the hiring data on Friday, basically suggested that now all eyes are going to be on Powell. If Powell comes out less dovish than the market would like, he doesn't even have to come out hawkish. I think even just less dovish would actually cause the markets to rethink their positioning at the moment. The markets have been on a pretty steep bounce ever since, we started to sort of anticipate dovishness by the end of the year. So it'll be interesting to see what happens.
So Gina, let's speak about that positioning, because it sure feels as though that more bullish jobs number on Friday did shift some positioning, certainly sentiment in the marketplace. There is not as much of an expectation now of a massive rate cut coming up later on this month. So take us through whether or not the expectations really are there, and has the market been reset because of that jobs report?
Well, I think that the market was always sort of teetering as to whether or not that would happen. So I think that jobs report just basically continues to tell us that it's a mixed bag. And that was always the case. So if you kind of walk that forward and say, let's say that Powell comes out and he's somewhat more neutral than the market would like, you might see some of that froth come back off. But I don't think that we're necessarily any worse off than we were before. The markets are still probably softening. It's just a question of whether or not they're softening quickly, as to whether or not a rate cut is going to be imminent this year. And quite frankly, look, softness in the market, that's not a good thing. The economy slowing, that's not a great thing. So I think that the markets were sort of cheering about the wrong thing to start with.
What does it tell you right now that we do see a bit of a pullback, not just in the stock market, but also in the Treasury bond market as well? We are seeing yields tick higher. I remember right before the July 4th holiday, we saw lows of around 1.94% for 10-year yields. We're right back up into 2.07 this morning. So why is it that we don't see that bid for safety assets and treasuries like we would see in a downturn?
No, I don't think that this is this kind of a risk-off kind of move. If in fact now look, one of these markets is going to be right and one of these markets is going to be wrong. When you get markets moving in the same direction, then that doesn't happen for very long. I do actually think that, you probably will see, I doubt, just knowing how, that the Fed is pretty much on tenterhooks right now, I doubt that they're going to come out and say, oh, well, we're not as dovish as we were before, because I don't think that the market would, I don't think the market would like that. Not that it matters, but I don't think that would be great. If you look sort of at what it's doing across the market, it's not just in the U.S. stocks versus bonds. It's also sort of U.S. versus emerging markets as well. We're seeing emerging markets also sort of get nervous. And, you throw oil into the mix and you have a lot of, it's a really mixed bag right now. And if you look at the markets, they're richly priced. So why would you want to keep buying at this point? It makes no sense.